In 1996, Warren Buffett and Charlie Munger were asked about diversification and how they think about diversifying Berkshire's massive stock portfolio. Their response was rather shocking, and they gave an incredibly clear view on diversification and how they believe investors build true wealth. Let's watch the full clip, and then I will explain the key points afterwards.
My name is Mark Hake. I'm from Scottsdale, Arizona, and I'm very interested in your policies on diversification and also how you concentrate your investments. And I've studied your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable equitable securities portfolio, and there was one year where you only had 3 in 1987. So I have 2 questions. Given the number of stocks that you have in the portfolio now, what does that imply about your view of the market in terms of, is it fairly valued, that kind of idea? And second of all, it seems that whenever you take a new investment, you never take less than about 5% and never more than about 10% of the total portfolio with that new position. And I wanted to see if I'm correct about that.
Yeah, well, on the second point, that really isn't correct. We have positions which you don't even see because we only listed the ones above 600 million in the last report, and obviously those are all smaller positions. Sometimes that's because they're smaller companies and we couldn't get that much money in. Sometimes it's because the prices moved up after we bought them. And sometimes it's because we may be selling the position down even. But so there's nothing magic. We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to, have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
There were a lot of great points discussed in this clip, so let's break them down one by one. The reason Buffett has so many smaller positions in Berkshire's portfolio is because he can no longer put large amounts of money into every business, or because the price starts to move up after he starts buying the stock. There are 2 main takeaways from this. First, Berkshire is simply working with so much capital that they can no longer invest large amounts of their portfolio into some stocks. For example, if Buffett likes a business with a $5 billion market cap, then $1 billion would be 20% of the company. So no matter how much Buffett likes the stock, he won't be able to put large amounts of Berkshire's capital into it. Secondly, Buffett focuses heavily on value. When he buys a stock, he buys it below what he believes its value is. If the stock moves up to above what he thinks its value is, then he stops buying it. The reason he does this is because both risk and returns are directly associated with price. For example, using Stock Unlock's discounted cash flow calculator, we can see that based on my assumptions here, Google's future stock price is about $210 per share. And at Google's current share price, it would return about 10% annually. However, if Google were selling for $170, then based on my assumptions, it would only return 4.39%, which means its returns go down as its price goes up. If Google's share price were $250 today, then its annual returns would be negative 3.36%, which means the returns would be negative and I would end up losing money. The only thing that has changed here is the price paid, and you can see that at one price, Google makes a nice return, and at another, it would lose you money. Buffett knows this, and he always sticks to what he believes the value of the business is, and makes sure to buy it at a price where he will be getting an adequate return. Therefore, some of Berkshire's positions are smaller simply because he could not build out a larger position before the stock moved above where he wanted to be buying it. Moving on, Buffett says Berkshire is very happy to place large amounts of capital into single stocks. In fact, it prefers to do so. This video was recorded in 1996, and Buffett still seems to follow what he said in it, because Apple alone now makes up over 50% of Berkshire's entire stock portfolio. So Buffett has 50% of his portfolio invested in one stock, which is pretty extreme concentration, especially at Berkshire's size. This brings us nicely to the next point, which is that Buffett believes diversification makes little sense for anyone who knows what they are doing. He said that it is crazy for an investor who knows how to analyze and value businesses to own 50 different stocks, because there just aren't that many wonderful businesses out there. Additionally, if you know how to analyze and value businesses, then why would you want to put money into your 50th best idea instead of your best idea? He considers doing so to be crazy. This is something that I have started to do in my own portfolios as well. Whenever I am looking for new investments or looking for places to invest more money, I first consider adding to my largest positions. The reason is because anything I add to would have to provide more returns or more certainty than my largest investments. Otherwise, it might make more sense to just continue adding to my top stocks. This is also where the discussion of diversification really comes into play, because many investors may add to other positions rather than their top holdings just for the sake of diversifying their portfolio, which is totally fine, by the way. But Buffett is just saying that you do not need to diversify for the sake of diversifying. Or in other words, diversification is not absolutely necessary for an investor. He then gives the example that if Berkshire was able to deploy all of its capital into just 3 stocks, he would be perfectly happy to do so. In the book, The Snowball, which is the story of Warren Buffett's life, it was revealed that there were multiple times when Buffett would have his entire portfolio invested in a single stock that he believed was an incredible opportunity. Additionally, when he ran the Buffett partnership early on in his career, He would regularly have only a handful of stocks, and his returns were absolutely incredible. But again, due to Berkshire's size now, he can no longer only own a handful of stocks, even though he sounds like this would be his preference. He then discusses a very interesting point, which is that he believes there is less risk in owning 3 wonderful businesses than owning 50 average businesses. This is because the wonderful businesses are protected against competition and the volatility of the economy. Now, before watching this clip, I did not think about this before, and now that I have watched this clip, I completely agree. Here's one way to think about it. How likely is it that Apple is going to go bankrupt or disappear? It is the largest company and brand in the world, and its products are used by billions of people. Is it more likely that Apple will disappear, or that 49 other average small businesses will? The point Buffett is trying to make here is that a business like Apple could provide investors with less risk than 49 average businesses, due to how high quality Apple is. And therefore, he does not see the need to diversify money outside of Apple because he is arguably taking less risk by owning more of it. He then finishes by saying if he were tasked with protecting his family's wealth, and he had the option of investing in 3 high-quality businesses versus 50 average ones, he would invest his wealth into the 3 high-quality businesses. So even if it came down to protecting his and his family's wealth for the long term, he would still not choose diversification, and would pick owning 3 high-quality businesses instead. Him and Charlie make it pretty clear how they feel about diversification, and how they believe it is not necessary, can increase risk, and lower your overall returns. However, Buffett has also consistently preached that the average investor should just own the S&P 500 index, which would diversify your portfolio across the top 500 businesses in America. So how does he go from saying he does not believe in diversification, yet recommends the average investor should diversify? It is because Buffett and Charlie are not your average investors. They have an almost inhumane ability to analyze and identify high-quality businesses and their values. So for them, diversification does not make any sense. But for the everyday investor, diversification may be the best option. The historical returns of the S&P 500 have also been enough to produce incredible wealth. So there is an argument that simply owning the S&P 500 removes the need to analyze, value, and search for high-quality businesses altogether. It really comes down to knowing yourself and knowing what is best for you as the individual. What is best for Buffett may not be what's best for you. And as investors, we should always find an investment strategy that works for us over the long term. It should work with your temperament, comfort levels, and lifestyle. Not everyone enjoys or even wants to be analyzing stocks. And in fact, I know lots of people who do not enjoy it at all. And for them, Buffett says simply owning the S&P 500 would probably be the best option. But for those of us who do enjoy analyzing businesses and finding unique investment opportunities, then he says that you absolutely do not need diversification. So at the end of the day, to diversify or not really comes down to you. Therefore, the main point of this video is to say that diversification is an option, but not a necessity. Like with everything in life, there are pros and cons to diversification that every investor needs to individually consider. But that is going to wrap up the video, everyone, and thank you so much for listening, and I do really hope that you enjoyed this video. If you did, then please remember to leave a like on it, as it does really help out my channel, and it helps get this video in front of new audiences. Also, if you have not subscribed already, then please consider subscribing to my channel if you want to see more Warren Buffett and stock market related content. But with that being said, that is going to wrap up the video, everyone. So thank you so much again for watching. I truly do appreciate it, and I really hope to see you all again in my next video.